Welcome to the Explainer. Today we're going to break down one of the most fundamental tools in trading, the call option. We're going to demystify how it works, looking at it completely from the buyer's point of view.
Okay, before we really dive in, just a quick and really important heads up. This is all for educational purposes. Options trading comes with some serious risk, so please think of this as a workout in the gym, not as actual financial advice.
So let's start with a situation you've probably been in. You're looking at a stock and you are just convinced it's about to go up. Now, you could buy the stock itself, but that can tie up a whole lot of your money. So the big question is there another way? A way to profit from that move up, but with way less cash on the line? Well, the answer is a big yes. And that's exactly what a call option is for. It gives you leverage, letting you control a big chunk of stock for a fraction of the cost.
To make this all super clear, we're going to skip the boring theory and just walk through a single real-world style trade from beginning to end.
All right, here's the setup for our trade. We're buying a call option on SBI Bank. What does that mean? It means we get the right, and this is the key part, it's a right, not an obligation, to buy shares of SBI Bank at a fixed price. That price is called the strike price, and for us it's 460 rupees. Now, for that right, we have to pay a small fee, which is called the premium. In this case, we paid 1750 rupees.
Okay, so we've placed our bet, we've bought the option. Now what? Let's jump in our time machine, fast forward to the expiration date, and see the three main ways this whole thing could play out. All right, scenario one. This is the home run, exactly what we were hoping for. The stock has taken off and is now trading at 500 rupees. That's way above our strike price of 460. This is good news.
So how much did we actually make? It's a pretty simple two-step process. First, we use our right to buy the stock at 460. But since it's worth 500 on the open market, that's an instant 40 rupee gain. But, and don't forget this, we have to subtract the cost of the ticket, that 1750 premium we paid to get in on the action in the first place.
And there you have it. That leaves us with a net profit of 22 rupees and 50 paisa per share. A very nice trade.
Okay, but we all know the market doesn't always do what we want, right? So what happens if the stock just fizzles out? What if it ends up right at our strike price of 460, or even worse, it tanks and falls all the way down to 360?
And this is the real beauty of buying a call option. In both of these not-so-great scenarios, the outcome is exactly the same for us. Just think about it for a second. Why would you ever use your right to buy a stock for 460 rupees when you can just buy it on the market for 460? Or even cheaper, at 360. You wouldn't. It makes no sense. So you just let the option expire, it becomes worthless. And your total loss? It's just that premium you paid, the 17 rupees and 50 paisa. That's it. That is the absolute most you can lose.
Okay, so those three specific prices are helpful, but let's be real, the stock could land at any price. How do we get the big picture? How can we see our profit or loss no matter where the stock ends up?
Well, that's where something called a payoff structure comes in. It's basically a map, a visual guide that shows you your potential profit or loss at any possible stock price when the option expires. It's a really powerful way to see the entire landscape of your trade.
Let's start with the downside, because that's what everyone worries about first. And this is the golden rule for a call buyer. Your loss is capped. Period. It doesn't matter if the stock goes to zero. The absolute most you can ever lose is that initial premium you paid.
Okay, so we know the absolute worst case scenario. But what's the magic number where we stop losing money and actually get back to zero? You know, the point where we cross from the red into the black? That's our break-even point. And figuring this out is super simple. You just take that strike price, 460, and you add the premium we paid, 1750. So the stock has to climb all the way to 477 rupees and 50 paisa, just for us to get our money back. Any single paisa above that is pure profit in our pocket.
Okay, but hold on. For every buyer, there has to be a seller, right? We've only looked at our side of the story. Who's on the other side of this bet? Let's take a quick peek from their perspective.
You know, it's pretty amazing. The seller's position is literally a perfect mirror image of ours. Our risk is their reward, and our reward, well, that's their risk. That maximum loss we had, the premium, that's their maximum profit. And our unlimited profit potential as the stock goes to the moon, for them, that's unlimited risk. It's a perfect, fascinating symmetry. Whew, okay, we have covered a ton of ground. So let's just pause for a second and boil this all down to the absolute essential rules you need to know when you're buying a call option.
These are really the core ideas. First up, it all starts with being bullish on a stock. Next, and this is huge, your maximum loss is always limited to that premium you paid out. On the flip side, your profit potential is, in theory, unlimited. And always remember to calculate your break-even point, which leads to the final rule. You only start making real money when the stock price blows past that break-even number.
And that brings us to one last, really interesting question. We get the buyer's logic, right? Limited risk, unlimited reward. It makes total sense. But what about the seller? Why on earth would anyone take the other side of this trade? Why would they accept unlimited risk for just a small, limited gain? You know what? That's a great question, and a fascinating story for another explainer.